Big U.S. banks plan a tokenized deposit network to counter stablecoins. The four largest banks in the United States are building shared crypto rails of their own. JPMorgan Chase, Bank of America, Citigroup, and Wells Fargo plan to launch a joint tokenized deposit network operated by the Clearinghouse, the real-time payments company those same banks co-own. The plan was reported on June 4, 2026, with a target launch in the first half of 2027. The framing in crypto circles has been banks versus stablecoins, and the competitive motive is real. But the product is not a stablecoin. It is a tokenized deposit network, and that difference is the whole story. Bank deposits, recorded on a blockchain. A tokenized deposit is an ordinary bank deposit represented as a digital token. The dollars stay inside the banking system, carry the same credit risk profile as any other deposit, and sit under the existing regulatory and accounting framework that already governs the banks holding them. The token is just a new way to move and settle that deposit. A stablecoin works differently. It is a separate asset issued by a non-bank, backed by reserves the issuer holds, and it lives outside the deposit base. When you hold USDC or USDT, you hold a claim on Circle or Tether, not a bank balance. When you hold a tokenized JPMorgan deposit, you hold a JPMorgan deposit. That distinction is why the banks prefer this route. Pending U.S. legislation would let stablecoin issuers pass interest-like yield to holders, a feature the banks oppose because it pulls cheap deposit funding out of the banking system. Tokenized deposits let the banks match the speed and programmability of stablecoins without giving up the deposits those stablecoins would drain. The clearinghouse is the shared backbone. Running the network through the clearinghouse matters. It is the operator behind the RTP real-time payment system and is co-owned by the large commercial banks, which gives the project a neutral, shared backbone rather than one bank's private ledger. That shared structure is what turns four separate in-house experiments into something corporate clients can actually treat as infrastructure. The intended early users are large multinational corporations, not retail. The Clearinghouse CEO David Watson described a radically different future for on-chain payments and finance. The concrete use cases are programmable treasury operations, real-time liquidity management, and cross-border settlement that clears in seconds instead of days. For a treasury team moving money across subsidiaries and time zones, instant settlement on bank money is the pitch. A blockchain vendor has not been chosen yet. JPMorgan already runs JPM Coin internally and has extended it onto Base, the public chain connected to Coinbase, so the technical groundwork for tokenized bank money on public rails is partly built. The open question is whether the consortium settles on a private chain, a public one, or a permissioned layer on top of a public network. Stablecoin spending stays untouched for now. This is a corporate treasury and wholesale settlement story, not a consumer one. A 2027 target is far enough out that nothing changes for cardholders today. The sell-off backdrop underlines how early this is. As of June 5, 2026, Bitcoin trades near $63,064, down 1.8% on the day, with the Fear and Greed Index at 17, deep in extreme fear. Bank infrastructure plans do not move on that clock. The longer-term overlap is with the rails behind crypto spending. A growing share of stablecoin-funded cards settle merchant payments by converting a stablecoin balance at the point of sale, and an expanding set of payment networks now use stablecoins for back-end settlement. If tokenized deposits become a credible competitor for cross-border and programmable payments, they compete for the same corporate flows that issuers like Circle and Tether have been chasing. That contest between bank money on-chain and non-bank stablecoins will shape which rails the next wave of card and remittance products is built on. There is also a risk distinction worth holding on to. Tokenized deposits keep funds inside a regulated bank, with the deposit insurance and supervision that implies. Stablecoins keep funds with an issuer whose reserves and redemption terms you have to trust directly. Neither is strictly safer in all cases, but they fail in different ways, and a user funding a card from either should know which one they are holding.